You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, we've had some fun here over the last week or so. Prior to last week's episode, we had just had a midterm election. And the day after we taped Options Playbook Radio, we saw the CPI numbers. And for once, everybody's saying that inflation could be peaking, i.e. waning from its highs, and it did actually happen. So we had a decent CPI number. The market rallied off of that number, and it was more about the direction, the fact that people were just waiting for it to not be higher than anticipated, and just the direction by itself, the fact that it wasn't an amazing number, but just the fact that it was lower than anticipated and actually showed that we may be at a peak with inflation made the markets happy. So prior to that, we've been talking about the VIX for quite some time here on Options Playbook Radio. All the way back in August, talked about the fact that the VIX was trading at 20, right around that 20 level. And to me, the 20% level is really what I would consider low volatility. It was kind of established after the pandemic. It seems like we could never break through that 20% level. So the new low, as far as I'm concerned in the markets for the VIX, is whenever we see it around the 20% level. And guess what? We were there at the beginning of August and talked a lot about the fact that not really sure why the VIX was that low, that the quote-unquote fear index wasn't more fearful. And before you know it, we did get through October and September, two of the more scary months on the calendar, year in and year out. They always prove to be. And yeah, we had a couple of rougher months. The VIX reciprocated by going all the way up towards the 30% level. Before our news last week, it was trading right around 26, just a tad bit above that level. And so we went out and sold the November 16th expiration. And oh, by the way, I should let you know that it is November 16th. And the options did expire today that we sold in our paper trade last week. Markets are closed, so we do know that they expired. And the trade that we did was we sold the 28 strike call and bought the 30 strike call for a net credit of around 40 cents. We talked a lot last week about the fact that the VIX tracks the futures. I actually invited people to email me if that concept was a little out of bounds for you, and I had a lot of people do that. And I did actually email out a blog that I wrote a while back that's still relevant about how the VIX futures contracts really are they are what drives the expiration for those option contracts. So that November 16th future contract was trading a little bit higher than where the VIX was at. The VIX was at 26.09, and I think that the futures contract was like 26.80. Don't quote me on that. I didn't write it down from last week. So somewhere close to that. And so with that said, the market, the CPI coming out and being strong, that was a risk. That was why the VIX was where it was. And right now we see the VIX index, it closed today at 2411. It never really, it never went higher. When we talked about it on the show, that's where the VIX was at. And it never went above the 27 range. So really no risk to the trade. Just would have rode it. We put it on for 40 cents. If I could have bought it back for 10 cents at any point in time, I would have done that. And took my 30 cents and moved on. We had 2 points of risk. Not bad at all. Simple trade, straightforward. So it's time to move on. So I'm going to keep that theme. The VIX is still around 24. We did have a down day in the markets today. Not ridiculous, but we've had a few good days, and now we had a down day. We still see the VIX trading around that 24 level. I still think if the markets stay strong going into the holiday season, people are going to be worried about buying Christmas presents and such. So we're going to have a holiday week next week. For Thanksgiving, the markets will be closed, and on Friday, November 25th, the markets will be a half day. So why not sell a little bit more premium? Let's do it. And I don't get that many opportunities, or I don't know why I don't talk about them as much, but I kind of think sometimes iron condors can be a boring thing to talk about, because all you're looking for is time decay. You're looking for markets to just kind of chill a little bit, looking for the VIX index to come down. So this is a little bit of a refresh and repeat strategy that we're going to do this week, but this week is going to be an iron condor, and we're going to do it in the SPY. Now, I personally like to look at the SPX if I'm thinking of iron condors, but it's not about me personally. This is always meant to be a paper trade and not meant, as always, not meant to be a recommendation. All we're trying to do here on Options Playbook Radio is take one of the 40 plays inside the options playbook, look at the market conditions, and try to make that play fit into what's going on in the markets right now, or whatever underlying that we're looking at. And then you can take this knowledge and hopefully learn something from it and decide what underlyings you want to trade on, what type of risks you want to take inside your portfolio. So we're going to do a really straightforward trade this week in that we're hoping that the markets will just stay a little bit tame, a little bit down, a little bit up. We're going to do it fairly short term, and we're going to use an expiration that is going to be the half day on that Friday, November 25th. And we're going to do an iron condor, a good old iron condor. And I don't mind at all. I'd like you to look at the iron condor on a paper trade, but you can choose a direction and just do one half of this iron condor if you'd like. In other words, look at doing a short put spread, or if you're bullish, the put side, if you're doing a short put spread, that means you're bullish. Or you can do the short call spread if you're bearish and just do one half of the trade going into the holiday. That would be the thought. But in this point in time, I don't mind the concept. We've got the VIX still at a decent level of just trying to sell a little bit of premium going into a holiday week in the exchanges. So with that said, the trade that we're going to look at this week, so we're going to stick in the SPY. It's more of a retail trader world, and we're going to look at the November 25th expiration, 9 days away, and we're going to go approximately a standard deviation move. I'm actually targeting, if you want to get kind of fancy with it, I'm looking to sell around the 20 delta put and the 20 delta call. And so in this instance, we're going to go 3 points wide, And we're going to sell on the call side the 406 call with that November 25th expiration. At the same time, we're going to buy the 409 call. That's going to be our protection. And then down on the put side, we're going to sell the 385 strike put. And then we're going to buy the 382 strike put. So we have 3 points of risk. Now, the one thing that I do know about the marketplace, I don't have a crystal ball or anything, but the markets usually cannot go up and down at the same time. So only one of these spreads can be at risk. And the brokerage firms know that. So one of the nice benefits of an iron condor is that the maximum loss is only $3, and that would actually be the margin requirement on that trade at most brokerage firms. It's what the max risk would be on the trade, not the fact that you have a short put spread and a short call spread. So the maximum you can lose is $3. We're going to bring in, or the maximum you could trade for, I should say, is $3. We're going to bring in 90 cents. That means our max risk is $2.10. Our max upside is that net credit of 90 cents. We're a good bit out of the money. Market right now is at 395.45. It was down 304 on the day, the good old SPY was. And that's simple. That's straightforward. We're looking for things to just settle down a little bit. Maybe we get a little bit of a drop in the VIX index. We're going to put this on for a net credit of 90 cents. I do not mind at all legging out of an iron condor. I'm not very big on legging out of actual spreads if I'm just doing a short put spread or a short call spread, but I do not mind doing that on an iron condor. It's another little benefit that you have. So if I do see the market coming up on the puts, or let's say it's going towards the 406 call strike. That's the strike that we are short. If it's going that way and I can buy that put spread back for a dime or 15 cents, I'm going to apply that logic, because that's exactly what I would do if I just sold a short put spread. If I can get the bulk of that net credit back, I'm going to do that. And I'd also do it on the other side. If we saw the market start going down towards our short put strike or that 385 level, I would consider going out and closing that short call spread, and then managing the side that has the most risk, because that's the direction of the marketplace. But hopefully we get a little down, a little up. We get a little bit of chop going into this holiday this weekend. We do have some retailers that are announcing, but we had a lot of those announcements actually did come out just over the last 2 weeks. We had Walmart, Home Depot, Target. So quite a few of those companies have already reported. So interesting time to consider doing a iron condor, which I don't get to talk about that much. Okay, so let's summarize it here. We're looking at an iron condor in the SPY. Today, it is November 16th. The markets are closed. The SPY closed at 395.45. We're going to look at the November 25th expiration. We're selling the 406 call, and at the same time buying the 409 call. On the put side, we are selling the 385 call, and at the same time buying the 385 put and buying the 382 put. We're trying to get this done all in one gaggle of securities. And the midpoint right now, based off of the markets, and the markets are closed, is a net credit of 90 cents to the account. That's our maximum upside. 3 points wide is our maximum risk. So minus that 90 cent credit means that our max risk is $2.10. And that's it for this episode of Options Playbook Radio. If you have any questions you'd like me to try to address on the show, please send them to me at theoptionsguy@invest.li.com. I'll still throw that out there. I had quite a few people that wanted my VIX blog, talking about how the VIX, the actual spot VIX index relates to the futures contracts. Happy to mail that or email that to you if you want to send me an email. And If you'd like to learn more about what we do here over at Ally Invest, please follow me on Twitter. My handle is @BrianOverby. Quite simple. I send out tweets about all of the educational stuff that we do. And until the next time, may all the options that you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.